How can universal life insurance be used for living benefits? Welcome back to episode 2 of the Secrets to Tax-Free Growth series. Last episode, we went over the differences between term, whole life, universal, and the 5 contracts to an insurance party. Now, if you just watched last video, you heard about the tax-free access, the tax-free transfer, the tax-free growth. You might have heard me mention policy loans, but if that's all you heard, you wouldn't have been able to get the full picture of how this can actually be used. Another conclusion you might have drawn just from watching that video alone is, oh, okay, why can't I just put in $10 million for $10 million and $1,000 worth of insurance and just let that grow tax-free? Many laws have changed around universal life and just insurance in general, and that's what we're going to go over today, is how can you actually use this to your advantage. Universal life comes out in 1980, and there was a time where you could have done something similar to what I mentioned, where let's say you're putting in $1 million and you've got $1,020,000 worth of insurance, you're letting it grow tax-free, and you're just using it, you're not going to put anything else in ever again. Well, the first decade after universal life came out, from 1980 really up to 88, is when a lot of changes were made that really still apply today. In 1980, when it came out, what E.F. Hutton's brokerage firm actually realizes is what we just mentioned, say moving $1 million for $1,020,000 worth of insurance. Well, all of these people are pulling their money from banks, putting it into insurance, because why would I keep money in a bank that's giving me 1, 2, even if it's a high yield savings, giving me 5%? Why would I keep it there if it's taxable and I can just move it here and get this tax-free growth right away? Why would I do that? Well, that's what they were doing with their clients. Eventually the IRS or the government comes in and says, like, what are you doing? Like, you're taking all this money from all these banks, you're moving it over, and you're putting it in insurance contracts? Who moves all this money and uses it for retirement, just in insurance? They said, well, our clients do. Government clearly didn't like that answer, and they went to court. Well, they realized they weren't doing anything wrong, they weren't breaking any laws. That's why they had to start changing the laws. That's when TEFRA and DEFRA came out. TEFRA in 1982, DEFRA in 1984. Essentially what these do is they define the minimum amount of insurance you need to be able to be considered a life insurance contract and not an investment. So yes, you can still move over the $1 million, but you might need to have, say, $2.5 million worth of insurance. So there is still a little bit of cost of insurance there you're paying for. Because again, if the amount of insurance you have is so small above your cash value right away, well, what are banks gonna do? In fact, if you haven't seen some of my other videos or other videos on indexed universal life, you would know the reason they didn't terminate this, but just changed it a little bit, is because when banks had to reveal where their tier 1 assets are, well, guess where they were? In the insurance companies. People put all their money in banks because banks are these safest institutions, and let's just put them there and they're never going to go under. They're going to give me my money when I want it. But the banks actually put their money in insurance companies. So it's really just you putting money in the banks putting their money in the insurance companies. So when it comes to the safety of an institution, for example, I've heard, oh, I don't know about an insurance company. I don't know, is that safe? Well, where's your money now? Well, in a bank. Well, banks often put their money in the insurance company. Now, next was TAMRA in 1988. That goes to how fast you can get the money in. That we'll cover in a future episode. Now, in general, to be able to use these living benefits, we need to have the policy structured properly. Now, what we mean by this is when you put money into a universal life policy, part of it goes towards your cash value account, part of it goes towards your death benefit. Now, if that ratio is completely screwed up and 50% of your money goes towards the cost of the death benefit, well, who cares all these benefits you're getting in the cash value if you're taking a 50% tax cut right away? That's not why you're watching this series. That's not the point of getting one of these anyways. Now, this is so important. So many times people will watch a series like this, attend a webinar, watch YouTube videos, think, wow, this is amazing. Dart out the door, go to their nephew who sells insurance, have them set it up. We move $500,000. 10 years later, they say, why is my policy worth $200,000? I thought it should have doubled by now. Well, let's take a look at the policy. Oh, brother, this was structured miserably. Do not let that happen to you. Here's a couple ways you can know when you look at a policy packet if it is structured properly. In general, if we have a big number, a lump sum, or a number of assets that are being repositioned, what you're gonna wanna look at is the GSP, the Guideline Single Premium. Let's say it's $1 million, then your Guideline Single Premium should be $1 million. This means over the course of the policy, that's what you're gonna fund it with. Now, there's also the guideline annual premium. So let's say you were going to put away like $24,000 a year. If you were just going to do an annual amount like that and not a lump sum, or just mainly filling it in like the first 5 years, for example, that's going to be the number you want to look at. If you're putting $24,000 a year in, your guideline annual premium better be $24,000. Last little note here. If you are putting in, let's say, $1 million over the course of 5 years, because your guideline single premium in that case would be $1 million, after the guideline single premium is divided by the guideline annual premium, whatever that number is, so usually it's around 11 years, could be less. Once the GSP divided by the GAP has been hit, you can actually then start to fund the policy again with the guideline annual premium. There are some nuances to this, so be careful, but just a good rule of thumb there. What you can also do when you have an agent run you an illustration is have them run an internal rate of return report. This will show you at the very end the projected internal rate of return for your accumulation value, your surrender value, your death benefit. It'll show you all the details. This is accounting for the money you're putting in, which year you put it in, new money you're putting in, if it's like the annual premium later on, which years you're putting that in, when you're taking money out, the years that those loans are being done. And what it does is it gives you, with all of these years you funded, years you took out, years you funded, years you took out, here is your internal rate of return. That's the number that actually matters. You might average 12%, for example, but that's not the same as a compound annual growth rate, and that's not the same as internal rate of return. For example, one thing that I always use is, let's say you gained 100% and then lost 50% the next year. You averaged 25%, but you didn't gain anything because you're still where you started. So your compound annual growth rate was 0. So that number would be more reliable than average in that case, or at least the number that you'd want to look at. Well, in an indexed universal life, for example, you're putting money in multiple years. It's not just one time and then you're done. Now, it used to be that way, not anymore though. And because that's the case, we use internal rate of return, IRR, because that calculates when you put money in, what year you took money out, etc. And that's something you can always look at in a policy illustration on their fees report, just to actually see, okay, what is the internal rate of return that I can actually expect to get, even when I'm pulling money out and using it, of course, for your living benefits. One example I always use in terms of internal rate of return and looking at that as a net at the end of an IUL policy is this. With a mutual fund, for example, if you're in, let's say, a 33% tax bracket, let's say you're averaging 12%. Not sure if you're actually doing that, but let's say you are. Well, you average the 12% gain. Well, then you pay 33 or 35, 37 to use an actual tax bracket here in taxes. I'm just gonna say it's 33, so now you're back to 8%. Well, then what else do you have? Well, maybe you had an advisor. He does a 1 or 1.5% annual fee. Well, now you're not at 8%, take another step back, now you're at 6.5 or 7%. Was there any setup fees? Was there any other fees that maybe bumps you down to a 6.5 or a 6? Well, if that's the case, you took all these steps forward. Yes, you got your beautiful 12%, but then you just kept taking steps backwards, and now you're at this point where, yay, we got our 12% average, but all I did was wound up at 7 or 6%. And if that was the case, if you are in that tax bracket, basically what the E.F. Hutton brokerage firm, for example, realized is, what if we were able to take all these steps forward and just maybe net 1% back? So could we take 8 or 9 steps forward and net 1 step back? So let's say you take 8 steps forward and 1 back. Great. Well, if your internal rate of return was 7%, that's wonderful. You didn't get to have the big flashy headline of I make 12% a year, but at the end of the day, since yours is tax-free, you actually end up in a pretty similar spot, except you didn't have to deal with all of the volatility. You didn't have to worry about what if tax rates go up. You didn't have to worry about, when I die, is some of this going to be taxed when it goes to my heirs? And when you were taking money out of that policy, if you were doing it with, let's say, a variable loan rate, and you were loaning at, let's say, 5%, but the money kept growing at 7%, you actually get to continue making money on money you've already spent in your retirement. This is another huge thing that's important, is your net spendable income. It's not just who can get to retirement with the most amount of money, let alone even just most amount of money after taxes. Still, it's how much of this are you actually going to be able to use? If you have floors, and then you have these loan rates, for example, that loan out money at less than they continue to gain, you can actually pull out more, which again, you might have the same amount of money as someone else, but even though you have the same, you might be able to spend more because of those loan rates. Now, we will continue to get into the nuances of the IUL, going over all these things, breaking it down completely. And I do think it is important to note, I'm not saying by any means IUL should just be 80% of your retirement money, put it all here, and forget all the other vehicles that exist. I don't think that's a good idea at all. In fact, many insurance companies, based on your net worth or your income, only even allow you to get so much anyways. Even if this was 30 to 40% of your retirement income, it can still make a big difference, even just having that small portion, if you want to call it small, dedicated to something where you have the tax-free and you have the little arbitrage on money you've already spent. That is all for this one. A little more detail oriented here in this episode. Next, we're going to go over the common question of, doesn't insurance get more expensive as I get older? We will go over that, and I will continue to show you why I believe IUL can be in your best interest to really include in your portfolio. Can make a big difference. Continue to follow along. Congratulations on making it this far already. You just take the time to sit down, go through this series, and educate yourself all the way through. You really can take that next step closer to being able to be responsible and take full responsibility for your financial future. We will see you in episode 3.